Welcome, everybody. My name is AJ Wasserstein. I am a faculty member at Yale SOM, and thank you for joining us today for a Yale SOM Exchange alumni webcast. We have two great guests today. I'm going to very quickly let them do a self-introduction, but today we're going to examine a SPAC, a global search fund on steroids. So Noah, you're sort of the star of the show today. Can you go first and do a very quick self-intro?
Yeah, thank you, AJ, and thanks everyone for tuning in. My sort of background pre-SOM came out of public sector, worked for the governor of Colorado for 4 years doing economic development, came to SOM class of 2016, and then spent for the last 5 years working at SpaceX in California. And then I spent the last year sort of refocusing on investment, and the last 4 or 5 months setting up this SPAC.
Great. Thank you, Noah, and welcome. Eduardo.
Hi, AJ. Hi, Noah. Hi, everybody. I was a lawyer prior to Yale SOM. And then after the school, I ventured into investment banking for a couple of years, and then worked in private equity, initially in the States and afterwards in Brazil, where I'm originally from. And then since 2016, I've been an entrepreneur. I co-founded a company called Green4T, of which I'm CEO. And now, since January, I've joined Noah and the rest of the AXEQ team, SPAC team. So that's it.
Great. Thank you, Eduardo, and really appreciate both of you being here and sharing some valuable time with the alumni. So let's get right into it. Noah, can you just explain to everybody in simplest terms as you can, what exactly is a SPAC? What does that acronym stand for? What's a blank check company? But explain to us what a SPAC is, and Eduardo, as Noah's board member, feel free to jump in and correct them where necessary, okay?
All right.
I say that jokingly. Go, Noah.
Sure. Yeah, so SPAC, the acronym stands for Special Purpose Acquisition Company. They have been around for several decades and have gone through sort of feast and famine periods. Currently in their latest, or hopefully still continuing their latest feast period. At the simplest term, it's an alternative way to take a company public. An analogy that my partners and I have come to like is that a SPAC is like a trolley service where you're giving white glove service to concierge, a nice private company that wants to go to the public markets. In maybe more cut and dry terms, essentially you're a subcontract investment banker for 2 years. But you've got sort of a unique background, a unique conviction, a unique strategy. And our team is very sort of entrepreneur and operator heavy. So we sort of look, act, and talk and think differently than a banker might. But we are functionally doing very much the similar role as an investment banker.
Got it. Eduardo, what would you add? Is that the right way to think about it?
I think that's the right way to think about it. I mean, it's essentially, it's a blank check company that raises capital through an IPO, right? And it raises capital on the background of its founders or sponsor team, as you like it. Essentially, we have 2 years. That's generally what the industry has, 2 years to complete an acquisition, which people call a de-SPAC. And it's technically a merger. It's not an IPO no more because the vehicle is already listed, but the merger should happen in 2 years, 2 years time. And as Noah said, it's sort of it's an alternative way for a good company to become public. It cuts through a lot of the mechanics of a normal IPO, and for the company, from the company's perspective, you have price certainty, right? As far as in an IPO, you're subjected to the markets and the book building and the whole underwriting process. So you don't have that in a de-SPAC situation.
Got it. So Eduardo, just to clarify there, when you do a traditional IPO, you don't know exactly what the valuation is going to be until it happens. But in a SPAC, the blank check company is effectively buying slash merging with the target at a valuation specific number. Is that correct?
Right. That is correct. And there is one other interesting thing, since it's a merger, not an IPO, for the SPAC investors that invested in the IPO, they will have a final say, right? So if they don't like the acquisition for one reason or the other, they can vote against it. That works differently as well if you think about it as a traditional fund or a blind pool fund, where you give the money to certain sponsors and you trust that they'll make good investment decisions. In the SPAC world, the investors still have the final say in the investment, and also the company is allowed to present to the market financial projections, which also works differently than the typical IPO, where you're not allowed to do that.
Got
so,
it. Okay. Yeah. So just to be clear, Noah, this is an investment vehicle that seeks to buy an existing operating company because the SPAC itself has no operations whatsoever. Is that correct? Okay.
Yeah.
So this is exactly like a search fund. I teach a course at Yale SOM on search funds, and this is just a much grander scale. So we try to buy companies with 1 to 3 million of EBITDA, and you're probably buying companies with 100 to 300 million of EBITDA. Is that fair, Noah?
Yeah, depending on which sector, maybe we would go down to 40 to 50 million EBITDA. But yeah, we're an order of magnitude more EBITDA than a search fund in your class.
Sure. Okay, so let's Noah, what I'd love to do for our listeners is sort of connect your journey from SOM to SPAC entrepreneur. So maybe without just recounting your resume, but can you sort of help us cross the bridge from graduation to Wall Street big shot, doing a SPAC IPO, and how you got there, how the building blocks fit into place to sort of be in this entrepreneurial role that you're in now. I'm going to invite all of our listeners to use the Q&A function at the bottom of the screen. So if you want to submit questions, that's probably the best way to do it. And I'll leave those into the conversation, or we'll hold questions for the back end. Noah, so how did you get to this point?
Yeah, of course. So, I mentioned pre-SOM, I worked in state government. State government is not something that people think of as an entrepreneurial place to be. I was in an office, though, that sort of prided itself on focusing on moving at the speed of business. And my sort of focus area was on the entrepreneurship sort of ecosystem. So one of my really, probably the accomplishment that helped me get into SOM was put together a program to provide non-dilutive grants to early stage companies in Colorado to help them create jobs. So it's a big sort of focus on economic development, job creation. Fun fact, one of the first companies that ever received a non-dilutive grant from that program that I created is completing their de-SPAC merger transaction this Friday. It's Lightning eMotors. So they're actually part of the SPAC story, and this is 8 years after receiving a grant from us. So I was in a very entrepreneurial role, even though in this sort of big entity. Came to SOM, always wanted to work on an IPO. I actually took a course, the role of counsel in the IPO process at YLS, one of the sort of courses that you're allowed to take cross-listed. And when I came to SpaceX, again, it's a huge company. It is entrepreneurial. But within the company, I was also working on Starlink, which is sort of a startup within the startup. And as you've seen, the somewhat sort of schizophrenic back and forth from Elon Musk about whether or not SpaceX will go public, the corner of SpaceX that would go public will be Starlink. And so when I was working on that project, I was sort of doing everything I could to get as close to the CFO and to the executive leadership to hopefully be on that core team that would help take Starlink public. So I sort of had this interest in entrepreneurship, this interest in IPOs. And I got close enough to to the product in Starlink, and I got close enough to sort of the global telecommunications value chain that I saw sort of gaps in the ecosystem internationally on a digital infrastructure perspective. And I end up leaving SpaceX to try to focus on how to invest, how to bring capital to emerging markets to develop access to the internet, whether that's data centers or fiber networks or cell towers. Because I saw actually this big market opportunity that even if Starlink is very successful, there's still a lot of people that would need to be connected. And this, again, for me, ties back to working in economic development and focusing on creating jobs and economic opportunity that started pre-SOM. And I would say SPAC was not the first approach I took. Last year, I tried and failed several times to raise private equity type vehicles to invest in telecommunications assets, because infrastructure typically has some of that more patient capital approach. And I identified a failure mode, or sort of a challenge in raising capital for emerging markets, is everyone's wondering where's their exit going to come from. And by everyone, I mean the limited partner, the sort of the big money, whether that's an endowment or a pension fund. They want to know, is there going to be another fund that comes along bigger than me in 7 to 10 years and buys my asset to give me the multiple on invested capital that I require for my shareholders? And after seeing how hard it is to raise capital from those sorts of more conservative investors to invest in emerging markets, I looked over at SPACs and saw a much more risk tolerant and, in fact, risk seeking pool of capital that does the exit first. It solves that key failure mode that I found, when I was trying to raise private equity type vehicles. And so I thought, maybe we can connect the dot here. Maybe we can build the bridge of access to capital in emerging markets, which for me still has this through line of job creation, still has this through line of sort of the impact that business can have on business and society. And so far, we're just working to sort of play out that thesis and see what opportunity there is to sort of bridge, the U.S. financial market to emerging markets.
Great.
With focus on infrastructure.
Great. Thank you, Noah, for sharing that. Eduardo, can you highlight some of the advantages and disadvantages of a SPAC? And maybe you could just think about sponsors, which are a type of investor, investors, and the target companies. What are the pros and cons of being involved in a project like this for each of those constituents?
Okay, well, for the investors, I think, as I mentioned, you have the final say on your investment. It's a different characteristic than investing through a blind pool, which are just two different ways to access.
Eduardo, just to clarify, can an individual investor preclude a de-SPACing and merger from occurring, or do they
not individually? No, not individually, but as a group.
But if an individual opted out, they would get their pro rata share of the funds in the trust, or no? No. As
collectively, since they are after the IPO, since they own the majority of shares, if the majority of shares do not like the acquisition, they make that decision, but collectively, not individually. So that's one advantage. I think the disadvantage, if you think about it, comparing to private equity capital or blind pools, you're not diversifying your capital, but at the same time, if you're managing money, if you're a pension fund or an endowment, you're allocating your money through private equity vehicles, and eventually, when you're allocating money through a SPAC, you're seeking something differently than diversification. I think in terms of fees, if you compare them, the way I think about it, it's fairly similar, because in a SPAC, you'll take a dilution of up to 20%. There's been SPACs that diluted less, not more than 20, as far as I know, at least.
Eduardo, I apologize. Just to clarify, when you talk about dilution, is that for the investors taking dilution from the sponsor?
Yeah,
okay.
From the sponsor.
Maybe you could just build on that, make sure everyone understands that. If you could clarify.
Once the the merger happens. So the sponsor group's founder shares get converted into ordinary shares and dilutes the pool of investors as a whole, usually up to 20%. So that's technically the cost of a SPAC. If you invest in private equity, you'll pay typically the 220 structure, plus also some deal fees that get deducted from your gross return. Usually the private equity industry will report a gross and net returns. That difference can be significant in certain types of funds and strategies. So if you add the net to gross difference plus the 220 structure, I think it's somewhat similar to the cost of money to reaching the company. So from an investor perspective, I think costs are similar. The advantage is to invest in a single entity. And you mentioned the target company. From the target company perspective, there is the certainty we mentioned of a transaction getting done. You know the price. And by the way, just to take someone's answer already in the Q&A, mentioned about forward-looking projections. When I mentioned that the forward-looking projections are possible, that's between the sponsor group and the target company, not to the end market, because the SEC did put some restrictions on what the target company can release to the public markets. But as a sponsor, and even though we're doing M&A, you have full disclosure. You can do regular due diligence that you wouldn't be able to in an IPO situation. So the target company takes away the market risk, get certainty, speed, and I think the disadvantage is maybe you could get a better deal going yourself public, right? If you take on those risks, maybe you can get a better deal than through a SPAC. And as far as for the sponsors, I mean, it's somewhat similar to private equity as how the sponsor gets paid. I mean, obviously, if you're managing a large blind fund, you have the certainty of your 2% a 2% management fee. The SPACs, at least the ones that we know in our SPAC, I mean, we don't get compensated at all during the time we're looking for a deal. It's only success based, so it's a different compensation scheme, let's say. But I think they both somewhat get to the same point in the end. If you make money for your investors, you get compensated. If you don't, then it's not that interesting.
Yeah. Okay. Thank you, Eduardo. Noah, can you comment a little bit on the SPAC market? What is this a golden moment for SPACs, or is this another example of Wall Street excess? I mean, I happened to read in the New York Times yesterday an article about SPACs. I think there's one in the Times or Journal every day. But yesterday, one article I read was about celebrities and their connection to SPACs. And Shaquille O'Neal, Serena Williams, Alex Rodriguez, Paul Ryan, and Billy Beane from baseball are all attached to SPACs, as well as business celebrities, but these are non-business celebrities, or not traditionally business celebrities. What's going on? I think I read yesterday also that there have been 300 SPACs formed in 2021 alone. Is that remotely correct? So what's going on? Is this a bubble? What are the competitive dynamics for you buying a company? Sure. Why the sudden infatuation with SPACs? New regulators, new administration. How might that impact SPACs? Take it wherever you want.
Yeah, great. And you did freeze for a minute. Can you still hear me though?
I can hear you.
Okay, great. Well, for one, I think the Shaq SPAC just has a good ring to it, so I'm not going to hate on that one. So why are SPACs so hot right now? And are we sort of in the golden moment or just past? And this is the question we ask ourselves, every day, several times a day. I get asked by investors. I think if we take a quick look at the last 18 months, pre-18 months ago, SPACs were happening, but at sort of very much a slow burn rate, on the order of single digit per month. And at the time, the companies that were much more sort of popular were, real businesses, a company that makes, frozen food, a company that, runs spas on cruise ships, a company that, may have been owned by the same family for 30 years and, their succession plan is to take it public. And in the last 18 months, there was sort of this shift that came out, I think, with sort of maybe three big reasons. First of all, very, very low, sort of the hunt for yield. There's so much sort of dry powder out in the market and people are trying to figure out something to do with it. And a feature of SPACs is that the IPO investor essentially has zero principal risk. So I like to say, when you invest in a SPAC at the IPO, you're buying a treasury bill with a lottery ticket stapled to the back. And so a lot of hedge funds and different folks that are even just looking for single-digit % yield, but better than a treasury can do, we're buying SPACs, and for a period of time, we're actually redeeming their $10 per IPO unit out of the trust account at the de-SPAC merger, and then holding on to their partial warrant and see if that gets into the money, and then that's their literal lottery ticket. So the demand on the IPO side has been incredibly strong because of that very, very low risk to principal. The other thing that was a driver here is they've standardized the SPAC. They've made it much more cookie cutter, much more standard. Everything's $10 a share. Everything has this sort of 24-month timeline. Everything has this fixed type of promote. Almost everything is, a half warrant per unit or less. And that just makes it a lot easier to sort of digest and think through. And then sort of the third sort of part of that, it's sort of maybe 2B, but I'll use it as my third, is that the market came up with a much more standardized expectation of raising a pipe before you consummate a transaction. So pipe.
Can you de-buzzword that?
I'll de-buzzword that, and I'll circle back and share a little SPAC math, which I think some folks would appreciate. So a PIPE is a private investment in public equity. Essentially, that's a second tranche of capital that you're raising in order to consummate the deal. In sort of the olden days of SPACs, PIPEs were rather rare, and when PIPEs did occur, they were raised by people that were sort of already invested and privy to the transaction. What's become much more common is having sort of sophisticated investors participating in PIPEs that may have not invested in the IPO, may not already be invested in the target company. It's literally fresh capital and fresh eyes. And typically it's very sophisticated investors. And so this is where I'll give a quick sort of SPAC math run through, and then we'll talk about what that means on the PIPE side. So essentially for us, we're raising a $200 million SPAC. The rule of thumb today, and what's been standardized as the market's expectation in the last 18 months, is we will raise probably ballpark another 200 million, say 150 to 250, but call it simple, 200 million in a PIPE. And then we will acquire typically less than half, or convert less than half of the company to go public. So if you do very simple SPAC math, we've got 200 million in our IPO, we raise 200 million in the PIPE, we buy 49.9%. Post money, we're doing enterprise value company of an 800 million transaction enterprise value. So that's generally sort of simple SPAC math. And if we go to the sponsor promote and the dilution point that Eduardo was mentioning, the 20% sponsor promote is 20% of that first 200. Once we bring in the PIPE 200, now our sponsor promote is 10% of that 400 million. And then once we buy 49.9% of the company, we're now at 5% or less of the listed company. That's how sort of the SPAC promote gets diluted. And the market prefers that you're low single digit % on your dilution as far as sort of the SPAC sponsor. So that's a little bit of SPAC math. But essentially the IPO investors have no risk to principal. The PIPE investors get to be well crossed and see the business and meet the management team and understand if this is a real valuation. And typically that's sort of the 1-2 punch where that's what's helped accelerate SPAC transactions so much, is that you've got people that are starving for yield, and then you've got people that actually get to look at the books. And when you put the two together, you get a lot of deals to go very fast. Are we overheated? Yes. Has it been crazy? Yes. If anything, when we started this journey just in January, it was sort of this go, 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 windows open, get out the door while you can. And the window goes back to this 24-month period. So if we look at from 2016 to 2020, there were 250 SPACs that raised their trust account and completed transactions. Of those 250, 241, completed transactions. One absolutely fell on its face. 8 fell on their face, but for arguably unrelated to SPAC reasons. 4 of those were focused on China and had different issues. 4 of those were focused on the oil and gas industry and had sort of endemic issues. So arguably people say, SPACs have had this 99 point whatever % success rate between, 2016 and 2020. Then in 2020, we've had another, 300 SPACs get listed. And now in the Q1 of this year, we've had another 300 SPACs get listed. So we're in the neighborhood of over 500 SPACs, of which probably less than 150 have completed a transaction in the last 18 months. So you've got, 350 plus SPACs that are still in this uncertain window where the second shoe hasn't fallen, they haven't run out of time. And so everyone can still say there's 99.9% success when you have a SPAC. But right now we've got 300, some material percentage of which are going to fall on their face. And that metric is going to change in the next, 15 to 18 months. And so everyone's rushing to get out the door before people realize what that sort of endemic risk is. I'd say our perspective is this is a necessary maturation of the vehicle. And the way we sort of approached the SPAC from the beginning is we said, we want to do a boring real company deal. We want to do a much more private equity looking transaction than the speculative venture capital, relying on projections for 2025 revenue to justify an insane valuation for a company that has an empty factory. That's the deals that have been being done are antithetical to our thesis. And so if anything right now, we think the market is, appropriately pivoting away from that sort of speculative focus and the sort of boring. I don't think we're going back to the boring frozen foods companies just yet. But I do think we are, our team and our approach is sort of like congruous with what we see as sort of a maturation of the market. So when we get down to the actual, numbers and, is the window closed or not? There were 300 in the first 3 months of this year, SPACs that went out. So that's, we're going sort of a run rate of 20 SPACs a week. Then we had 4 weeks where essentially there were 0 SPACs. Now there's been maybe 3 SPACs in the last 2 weeks. So it's really, really calmed down. Right now there's 250 SPACs just like us waiting to go out the door. There are 15 SPACs just like us waiting to go out the door from our specific investment bank, Cantor Fitzgerald. Cantor Fitzgerald is very, very execution focused, and they've sort of, they're not the leading IPO bank writ large, but they are probably the leading IPO bank for SPACs. So of the 250, we feel very confident that all 15 of Cantor's SPACs will be in the first, definitely the first half, if not the first quarter of that chunk that go out. And I think probably more than half of the 250, may never get out. But we sort of think because of the bank that we're with, we do have a very good shot of getting out the door. And our team, once we are out the door, we've got, very high confidence that we will be able to differentiate ourselves in a few ways. First of all, by geography, we're focusing on Europe and emerging markets. 85% of SPACs are focused on the United States. So already we're sort of in a smaller pool. And then we've got, probably over 200 years of collective experience in the telecom infrastructure industry on our board and group of advisors and core team. And we've got a lot of personal relationships with target companies that are sort of plausible for a transaction in the next, 6 to 18 months. So, for better or worse, in SPACs, you only need to do one deal. Our goal is to be a serial SPAC team, and that means that we're going to focus on doing the best deal we can as quick as possible. And then hopefully, as sort of the celebrity SPACs get washed out of the system, we'll have demonstrated a track record that we are sort of part of this next wave of, SPAC 2.0, where it's a more mature focus on real businesses. And hopefully we'll be some that are left standing after the Shaq SPAC and others are are in the rearview mirror. So
let's thank you so much. Let's get Eduardo in from the board perspective. What once you get out, what differentiates your SPAC from all the other SPACs? And granted, different SPACs are looking for different target assets, but what other than valuation can really differentiate a target company from saying yes or no?
That's a good question. Of the vast majority of the SPACs we've seen so far, most of them are U.S. focused. And a lot of them are run by, let's say, private equity types. Our SPAC is it's very much run by operators, and we do have some private equity types. I used to be from this industry as well, but most of us are either running a company or have run a company, and a lot of us with successful exits in the past. We think that will give us an edge when discussing with entrepreneurs that are in similar situations. The other thing that I think is unique is the emerging market focus. Not a lot of SPACs are focusing internationally. When you go outside the US, the problem you encounter is size. Finding a desirable target of a valuation of around 1 billion or more. You have less of a supply of those if you look internationally. So the fact that this is an operator's SPAC with a lot of relationships gives us something around 80 potential acquisition targets that we know of, that we know people running it, or we know the shareholders. Out of those, we've been having discussions to prioritize. We cannot yet approach the companies because of where we are in the process of the filing. So soon we will be able to. So we think that gives us an edge, AJ, compared to the typical, say, US SPAC. We understand that those will be in a situation where they're competing with a lot of other SPACs. But at the same time, the capital market, and one thing I was going to add to Noah's point as far as this is a fad or no, I mean, I think we're just seeing a supply and demand situation as usual, right? I mean, the world is very low yield. The capital needs yield. The U.S. equity markets probably has today, maybe 5,000 listed companies. It used to be like 8,000 in the past. I mean, there's been competition from private equity taking some of those public companies private and then merging with other companies with concentration. So the market is bigger as well, right? So I think we're seeing a typical supply and demand story as usual. It's not the first time, but for sure, it's the largest we've seen from SPACs as far as activity goes. Just this year, the volumes are around 90 billion, which is more, the volumes raised 90 billion, which is more than the whole year last year. And it's more than 2013 through 2019 combined. So we're definitely seeing a pickup in activity. But there are assets out there. So off the, say, 500-ish SPACs that are out there, some certainly won't find a deal. Some will do bad deals. And the market will tend to normalize itself and differentiate good SPAC managers from bad SPAC managers, as it has differentiated in the past some other asset classes as well. And in the private equity world, I mean, we've seen funds from celebrities as well in the past. Today, Bonavox has a good private equity shop, actually, where it invests. So I think the separation from good managers and bad managers will happen naturally in the market.
Thank you, Eduardo. Noah, you mentioned that you want to be a serial SPACer. So can you just maybe define a little bit? Do you see yourself as an operating entrepreneur or financial sponsor? And when do you exit both personally and financially from the first SPAC to launch a second SPAC? And what value are you really adding if you're moving from SPAC A to SPAC B?
Yeah, so as I sort of mentioned up front, being a SPAC sponsor is, much more akin to being like an investment banker. And most things in finance, people like people with track records of doing the same thing. So once you do your first SPAC and you figured out how to actually execute with this vehicle, there's a sort of the market will trust that you can execute with that vehicle again. So for one, it's just we will be able to likely execute future transactions even more quickly and more smoothly than the first time. So just like with anything, there's a learning curve and you get better with time. As far as sort of financial exits, there's standard sort of lockup periods for founders of a minimum of, typically it's 12 months post de-SPAC merger. Typically, we would not be waiting those full 12 months to launch a second SPAC. So some
so
SPACs
just to make sure, no, I get it. Your money's still in SPAC 1, but your human capital's in SPAC 2.
Yeah, that's what we've seen in the market, where sometimes even people will launch SPAC 2 and SPAC 3, as soon as they even get SPAC 1 under contract. Just because there's sort of the lead lag of 4-ish months to get the next SPAC out the door. So you got to file your paperwork early. So this does mean that some of the SPAC capital does come from friends and family, and there are essentially at this point venture capital firms effectively that invest in SPAC sponsors and in SPAC platforms. So there's with a new asset class, there's sort of new funds and new opportunistic investors that are funneling capital into these vehicles. Typically, we will leave a minimum of one or more sort of folks from our team on as a board of directors. Since we are an operator sort of heavy SPAC, we see that as a big value add for target companies, that we've got folks that have industry contacts, industry experience, and can actually help drive growth initiatives for businesses from that sort of board leadership position. But functionally, yeah, we are not sort of the operational.
Can't hear you, Noah.
Yeah, okay. Yeah, Noah, for whatever reason, your audio is not working now.
Yeah.
I'm going to shift gears. We have 20 minutes left, and I was told to end promptly at 1 p.m. So Eduardo, can I just highlight some questions from the question box? And maybe you can take a look at those. Can you talk about maybe the target? You highlighted a little bit what you're looking for, but in general, do SPACs like yourself know what you're hunting for, industry, geographically, size, or some SPACs completely opportunistic? Maybe you could comment that in general. And you mentioned a little bit about your emerging market international twist. Why? So if you could address some of those topics, that'd be great.
I mean, in our case, most of us have some experience in what we call a digital infrastructure or IT infrastructure, which is the less visible piece of the IT chessboard, but that's how data gets from here and there, gets processed, and transmitted. So this whole spectrum of data center, satellites, fiber, cloud, and the orchestration between all of those IoT. So that's the characteristic of our SPAC, which is, we've been mentioning, there's a lot of people coming from the operating side more so than from the investing side, from from that perspective. So we will very likely stay within that area. Our mandate is slightly broader. We can look into some other types of IT assets, but I would say with a high degree of certainty that since this is our first SPAC, we will likely stay within the boundaries of these segments. The second part of your question was, can you repeat the second part of your question?
Are some SPACs completely opportunistic?
Yes, some are more opportunistic and just define geography, right? That was not our case. I think it ties back to what Noah was saying. I think we can, as a group, add value to this particular industry because of our collective experiences and relationships. So we're not gonna deviate from that. We're our mandate, it's fairly narrow compared to some other SPACs. But we do have, as I said, a vast number of potential targets that we've been identifying since we started all of this. So it gives us confidence that we can go ahead and execute on one of those transactions as fast as possible if there is a viable deal at the right valuation. And that will give us an opportunity, as Noah said, of maybe going to SPAC 1 or 2, sorry, SPAC 2, 3, 4 in a relatively short period of time.
And Eduardo, since you're so focused on international and emerging markets, we had a question. Did you consider listing anywhere other than the US? Maybe international exchange? And are there international SPACs that are listed in London or another exchange?
Well, Noah is probably more.
I can.
But the vast majority of this market is NASDAQ. So that's where the capital is. But there has been some international SPACs too, but nothing compared to the volume we've seen in NASDAQ. Maybe Noah can complement.
Yeah, I mean, there are very few SPACs outside of the US. I mean, it's as asymmetrical as, you know, NASDAQ versus LSE as far as, or Amsterdam. There's just so much more capital, and the analyst coverage is much more evolved. The sort of sophisticated level of investors is so much higher. The liquidity after a merger is so much higher. So for us, a big point that we see as a huge opportunity for the target companies that we're working with is the access to follow-on capital after the IPO. Whether that's issuing new shares for corporate paper to complete a follow-on acquisition. I know there's some questions about why we don't, you know, merge 3 companies together. We would much rather do, you know, a transaction that's maybe even a little smaller than, you know, our target, 500 million, 600 million enterprise value. And in the next 6 months, their plan is to issue more shares and acquire the next 2 or 3 companies, and that's going to send the stock price in the right direction. And for us, as far as our sort of sponsor promote, in a condition like that, like we would gladly sort of do earnouts on our own promote and say, you know, let's take this company public at 450 million. In the next 3 years, they're going to issue more paper or raise, you know, bonds at a relatively low interest rate on NASDAQ, and buy 3 more companies. And by the time the stock price hits, you know, 15, 20, 25, that's when we'll sort of trigger the earnout of our own promote. So it's much more about the long-term story for the company. And especially in markets outside of the US, local banks do not provide, you know, very, very low cost capital, very, very low cost debt. So being publicly listed in NASDAQ gives access to a much lower cost of capital for growth initiatives. Thank you.
Any thoughts on new administration and the SPAC trend? New regulators at the SEC, new federal administration. Do you anticipate gates open or some tightening, more regulation? I mean, the SEC has had a handful of "be careful about this asset class" pronouncements. Where do you think that's going?
Yeah, it's I think there's a few things going on. SPACs do give access to the retail investor to, more growthy venture capital type returns. They also give access to the retail investor to more venture capital type crash and burn situations. There is a level of sort of maturation on both sides of the market. As many SPACs as will, tank in the next 18 to 36 months, probably an order of magnitude more venture capital portfolio companies will tank in the next 18 to 36 months, but they're not under the sort of microscope of being in the public market. So if anything, this is just sort of like shining more of a spotlight on the realistic life cycle and journey of entrepreneurship in this country, which I actually don't think is a bad thing. It's going to be sort of a learning process. I think when we think about projections, practically the SEC has limited, the ability to use projections in an IPO because they want to protect, retail investor. That's the sort of explanation. The practical effect of that is that investment bankers severely underprice companies at IPO and stuff the book full of their preferred clients and create outsized returns for themselves and for their clients. So actually, prohibiting the use of projections is actually better for bankers and better for the high net worth individuals that are preferred clients at banks. And when you've got SPACs that are using projections, and I think if some articles will quote that an IPO is typically underpriced by 30 to 40%. If you look at if you look historically compared to sort of true value, SPACs are probably underpriced by 10%. So it's much closer to the actual value. That's better for the entrepreneur team that's trying to grow the business, and it sort of aligns the incentives better in that way. So I think it's really hard to see that tightening up is actually better for the little guy, which is sort of what you would expect a Biden administration to do. I could see arguments from bankers that they want more IPOs so they can underprice companies more and they can give more upside to their preferred clients. But that's actually not a better story for the GameStoppers and whatever else out there. So I think it's a really interesting and really complicated question. My hope is that the market will mature and evolve, but that it's not going to be that we're not going to sort of like retrench to just sort of the IPO strategy. And yeah, IPOs have sort of been, well, I'll stop there. I'll let another question get asked.
Yeah. So
before
let me move forward. We have a couple questions around majority minority positions when de-SPACing and doing the merger, and control. Can you answer and talk about, are you always in a minority or majority? And does the SPAC always have control?
So this is a never say never answer, because anything, the SPAC is very flexible. But I think this is actually another important contrast to private equity, which is that, SPACs take minority positions. You take one, maybe two board seats, but you're not overhauling a company. And so this is, to a strong founder team, to a strong management team, this is a total benefit, where if I'm going to go with, Macquarie or KKR or some mega private equity firm, they're going to parachute in their expert operators and they're going to take control out of my hands, and they're going to completely change the way, the company is run, the culture, et cetera. And there's sort of that proverbial pound of flesh that goes along with that active management. And typically that's really great value that private equity firms bring. They're sort of arbitraging the performance of management, and that's how they generate returns. For us, we're looking at what are companies that have the right team already. Maybe they're even at the end of a private equity fund's life cycle and just need a liquidity event, but they already have professional managers and they already have a great team. They just need to recycle capital and move on. I think this highlights how we are different from a private equity type entity. And part of the value proposition to a founder team is we do not take control. We are your sort of concierge to take you to the market, but then you still run your company after that, and you got a better valuation than if you did an IPO, and you got it done in, 4 to 6 months rather than 14 to 26 months. So
yeah. So I have a former student, Jonathan, who asked a question. Can you just clarify this T-bill with a lottery ticket concept, and why is principal not at risk? If you could clarify for how long principal is not at risk and when principal is at risk.
Yeah, great. So I'd say there's almost two flavors of lottery ticket and how I think about this. So the first is the Treasury bill statement. When you participate in the IPO, you purchase what's called an IPO unit. The IPO unit is a share, which is denominated at $10, and usually a fraction of a warrant. A warrant is essentially like a pre-baked option to buy another share. And the standard price within SPACs is that the warrants are in the money at $11.50. And so that's sort of the literal structure is, the literal lottery ticket is the warrant. When you put your money into the IPO, all your money goes into the trust account. And we do not have any access to the capital that we raise at IPO until we execute a demerger or a de-SPAC merger transaction. That's the only time that we can actually use this capital. When we are using this capital, there is a shareholder vote. And there were a few questions getting asked when this came up in one of Eduardo's answers before, but every single holder of a unit can opt to redeem their $10 share when they vote for or against the de-SPAC merger transaction. So even the little guy, even if we only lost $10 because one person decided that they wanted to take their $10 back, you could vote for or against the transaction and opt to redeem and take your $10 out of the trust account. So literally at the de-SPAC merger transaction, everyone that holds a unit has the right to redeem their share. This can create really nightmare scenarios for us as sponsors, because we could have 90% of shareholders vote for the transaction to go through and 90% vote to take their $10 back out of the trust account, and all of a sudden we're left with pennies, and the deal doesn't look nearly as good as it did 24 hours ago. So a big focus for us when we sort of get to that phase is how do we curate the pipe? How do we bring in the right rockstar investors in that second tranche of capital? How do we bring IPO investors to also participate in the pipe, and to opt to sort of literally, legally, contractually commit to not redeeming their shares out of the IPO? So there's a lot of work that goes into curating minimization of redemption, but that's the reason that there's no principal risk. Post-merger, then you're trading free float. And yeah, the stock price could tank, but the stock price also could do very well. If the stock price goes above 11.50, you can buy another share at that sort of 11.50 sort of strike price. So that's your sort of first version of the lottery ticket. The second version is, we could do a deal that trades at 20, 25, 30. That might take a few years to get up to that level. But a treasury bill is never going to, trade at 100% return at any term. So that's where it's like the warrant is literally a lottery ticket, but then the fact that we are doing a transaction that has sort of upward pressure on the stock price to grow, sort of that second version of why it feels from an investor like that lottery ticket.
So I got the 5-minute warning. So I'm going to try to get 2 more quick questions in before we say goodbye. So terse, pithy answers. Chaim, a former student who just raised a search fund, so different scale than your world. He's curious about an ETF like SPAC. for retail investors where you get broad, diversified exposure to this asset class. What do you think about that?
I'll tie it to the question before, if the SPACs are good for boring business or VC. My answer is definitely for more boring business, because you need diversification to invest in VC. You cannot take just a single position and expect to do good. You have to invest in 20 companies. You're going to lose money in 10 to 12. You're going to do boring returns in 7, and you're going to kill it hopefully in 1 or 2. So I don't think the SPAC carry, obviously the SPAC doesn't carry that. And the ETF of SPACs, there may be a good answer for retail investors. I mean, I don't personally think a SPAC is the greatest investment for the typical retail investor if he doesn't understand the risks, as Noah was mentioning, if he doesn't know what he's doing. But at the same time, considering that he doesn't necessarily carry principal risk, it's okay to take a bet and then get out. But if you have an ETF that's doing the job for you, sort of selecting good SPAC managers, I think that's pretty damn good, and that's okay.
Yeah. So last question from another former student, Michael, who has a lot of international emerging market experience and expertise. Are you going to find a big enough asset if you're looking for the, a $1 billion type deal in some of the smaller markets? Are there enough, once you sort of define the geography, define the industry, is there enough for you to find in your target strike zone?
I mean, I think the third challenge that we have to achieve is we need to find someone in that target strike zone who's also ready to do a transaction in the next 6 to 12 months. Yeah, are we tripping over them? No. But do we have personal relationships with what we think is enough? Yes. And for SPACs, worst comes to worst, SPACs are very flexible. And if we had to retrench to the United States to find a deal before the clock ran out, there's nothing prohibiting that. So we've got a lot of flexibility. If we had to retrench to a different industry, that's also a possibility. We are confident that we'll be able to get something done in the first 9 to 12 months, just based on the personal relationships with the folks on the team. But the flexibility of the SPAC means we've got many, many levers that we can pull to expand our universe.
Yeah. Okay. I'm going to stop there. Eduardo, thank you so much for being here, sharing your experience and wisdom with both the alumni group and with Noah. And Noah, thank you so much for sharing your personal journey into this exciting world of SPACs and really giving an inside view. Would it be okay? Can I offer the people involved in this webinar through the alumni portal to follow up with you if they have specific questions on SPACs?
Please.
Yeah, so pay it forward. Okay, great. Eduardo, Noah, I am so grateful for your time. Thank you so much. Great conversation. I learned a lot, and I hope our participants did as well.
Thank you, AJ. It was my pleasure.